Hi everyone, welcome back to the audit and attestation class. In this class of assessing the risk and developing the response to those planned risks, we'll be covering two major topics. First one is planning and engagement. Second one is developing an overall engagement strategy for audit and non-audit engagement. So let's dive into for more detail. So let's jump into the main thing, planning and engagement. So engagement can be an audit engagement or a non-audit engagement, right? So what is non-audit engagement?
Review, compilation, attestation.
Yep, review, compilation, preparation, attestation, right? And audit can be for the issuers or it can be for the non-issuers. What is the difference between issuers audit and non-issuers audit?
The issuer is a public company, non-issuer is a private company.
Private company.
No. What is the difference in their audit?
For issuer, PCOB standards are used.
Yes.
And for non-issuer, the AICPA standards.
AICPA standards are used. And for issuer, we need to report on financial statement audit as well as internal control. For non-issuer, it is not mandatory to report on internal control, right? So you need to keep this difference in mind, right? So accordingly, you need to plan your audit procedures and overall engagement. First, let's understand developing an overall engagement strategy, like we discussed earlier in the morning. So overall engagement strategy is at very high level engagement strategy. You can say 30,000 feet height. So in audit engagement, what do you do in the overall engagement strategy? First, determine the scope. Like what all things you need to conduct in an audit. You need to conduct like financial statement audit. Do you need to also perform the quarterly reviews? Do you need to perform, you can say as per PCOB standard? Do you need to perform as per AICPA standard? Does the company have multiple location? Do you need to perform consolidated audit, right? Do you need to perform the audit for different component also? Or in which industry, which is whether it's in banking, government, real estate, oil and gases, right? So those understanding you need to take, right? Second thing is to understand the timelines of the engagement, interim, year-end, quarterly, like I said. Then determine the materiality. So materiality we'll be discussing in detail in 3.6, I think. But here, like when you are doing the planning, so at that point of time, couple of things goes hand in hand. Like materiality also you need to assess at the very early stage, even though in book we'll be discussing slightly later, but that goes hand in hand when you actually conduct the audit, right? So in terms of determining the materiality, you'll be determining the materiality at the financial statement level, right? And then you'll be determining the materiality at a performance level, removing certain, you can say, detection risk. And then you'll be calculating the quantification of tolerable error. So what all things you can ignore, like you'll be calculating that amount as well, which is called tolerable error. And then summary of adjusted difference, SAD amount, right? These all we'll be discussing in detail when we'll be discussing the calculation of materiality. But high level, just keep in mind when you are doing the planning, at that point of time, parallelly, you need to calculate and determine the materiality for the respective level, financial statement level, performance level, financial account level, and the SAD level, right? Next is identification of high risk of material misstatement area. So at the planning stage, you will be identifying based on your previous year understanding or based on your interaction with the management, based on your understanding of the industries and client. So you'll be identifying the area where risk of material misstatement is high, so that you can plan additional audit procedure relating to those areas. Fifth is ascertaining the nature, timing, and extent of the audit procedure and the required resources to perform those. So nature of audit procedure, like whether you are performing inquiry, whether you are performing inspection, whether you are performing observation, or you are performing analytical procedure. That is called nature of procedure you are planning to perform. So in short, we'll be saying sometime NTE. So maybe like abbreviation you can keep in mind, nature, timing, and extent, like small short form would be NTE we'll be using at some place. Second is T, which is timing. Timing may be interim, quarterly, or year-end, right? Third is to the extent. To what extent will be performing those procedures, like number of sample you will be testing. So ascertaining the nature, timing, and extent of the audit procedure and the resources required to be involved. Like I think in morning, Ankush also said, we cannot involve like staff in preparing the audit committee presentation, preparing or delivering the audit committee presentation. That required the competency and commitment, or you can say experience and competency both for the respective level of work. So accordingly, you will be involving the experienced team member in the high risk area. For example, legal claims, litigations, assessments, claims, warranties, right? Or actuarials involvement, where like significant judgment is being involved and you have identified those areas as a high risk area. You cannot dedicate those area to like first year staff or a fresher, because he or she might not be in a position to embrace the complexity involved in those respective financial statement line items. So generally in those areas, you'll be involving the experienced person, like a senior, a manager, a senior manager, those kind of people, right? Second is determining the timing of resources. So when you are doing the planning of audit, at that point of time, you'll be assessing at what stage, how many resources will be required, how many staff required, how many senior required, how many manager time is required, how much is the partner time is required, so on and so forth. And you'll be doing like detailed planning of that, right? Next is appropriate allocation of audit team. So like I said earlier before, so you'll be allocating the work to the preparer and you'll be assigning the reviewer, right? And the preparer and reviewer would be assigned based on their competency and experience to the respective financial statement line item area. So you'll not be aligning anyone who do not have experience or competency to deal with those complex accounting area in those complex accounting area. Right? So in those complex accounting area, you'll be involving experienced people to prepare and review those respective area. Next is plan team meetings for briefing and debriefing. So every audit is required like different team meetings, internal team meetings. At least like 4 team meetings are required for listed company. One is at a planning stage, one is at the interim stage, right? And third is at the before finalization of accounts, and then last is conclusion stage, right? So depends on the nature of the audit, complexity of the audit, you can increase number of the internal team meetings. Right? So those things also you need to plan at the planning stage. Next is update an audit plan. Updating an audit plan is a continuous process throughout the audit. So it is not like that once you have made the audit planning, you cannot go back and change. Planning document is something which is required a continuous update based on the changes in the environment, based on the changes in the from the management side, based on the new facts and requirements which come in front of you, right? For example, when you are conducting an audit, which there might be some area you might not be aware of at the very early stage, but when you are conducting the audit, new facts and circumstances comes in front of you, right? That may require the change in the overall planning of the engagement. Might be, let's say, for example, you are doing an audit for the financial year 21. So in financial year 21, when you have done the planning, right? Let's say inventory is the area where you have not assigned any significant risk or high risk or risk of material misstatement or fraud, right? Everything was going smooth. But unfortunately, in September 21, the war between Russia and Ukraine has started, and you have a plant, big plant, where like your 60% of inventory is located in Ukraine, then how do you mitigate that risk, right? Because now you know it's hard to recover that material, right? And you do not know in what condition your inventory would be, right? So here the change in circumstances, what you have thought at the planning stage, it's completely different than what after 9 months, right? In that case of scenario, you need to modify your audit procedure. Now you will be considering might be inventory as a like high risk area, valuation of inventory, existence of inventory. Those assertions are, you can say, you need to test in detail. Accordingly, you need to give the valuation to the inventory in your financial statement line item, right? Make sense?
Yes, sir.
Are you guys with me? नींद तो नहीं आ रही?
नहीं अभी तो नहीं.
अभी तो नहीं आ रही.
किसी ने यस बोला सर?
आयुष
मैंने यस नहीं बोला यार.
यस किसने बोला?
मैंने तो कहा अभी नहीं आ रही.
राहुल नींद आ रही है?
नहीं सर.
कशिश?
Yes sir, everything fine.
पक्का?
Yes sir.
तो मेरे यहाँ पे तो 5 बजे होते हैं. So
you have to have a black coffee, huh? With you. Vineet, Avneet, Sandeep, all good?
yes sir, fine.
So this is very important topic from the audit examination, because like once you understand the planning, then you will be more comfortable when we go into the next chapter, which is like execution of audit, right? Because like in audit, all stages are interlinked with each other. If you miss something here, then it would be difficult for us to understand in next chapter or the following chapter, right? Now coming to the 6th point, update. Okay, sorry, 6th we have done. 7th point, initial audit, right? When you are doing audit first time. So what could be the scenario when you are doing audit first time? What could be the scenario when you are conducting audit first time?
It may be the new industry.
No, when it is called initial audit or first time audit.
When you are auditing the client for the first time.
Yeah.
Yes.
So that may be on account of auditor rotation, right? That
Auditor rotation, previous firm resigned, or previous firm was not able to give an opinion on the financial statement, or it is the first time the client is getting audited.
So we would be unaware of the business environment.
Sorry?
We would be unaware of business environment.
Yeah, yes. Yeah. So for that, it required a lot of additional effort from the auditor side. So most important thing what like Ankush has shared is the very last point. Like in US, for the non-issuer, audit is not mandatory, right? For them, audit is not mandatory, but might be this time they are going for a lending, or might be they are going for a funding, right? Might be they wants to go big, right? So they are conducting the audit first time. So there might be possibility till the previous year, some CPA or some accountant might be doing preparation for the financial statement or compilation, but no one has done any review or audit of the non-issuer, and you would be appointed as a first-time auditor for that organization. So this scenario is different than Indian scenario. In India, for all the private company, audit is mandatory, but in US, it's not mandatory, right? Make sense? So there might be a scenario when auditor is changing, or there might be a scenario that company is getting their financial statement audit first time. So when you are doing first time audit, so a lot of additional efforts and energy is being required to conduct that audit, right? Makes sense? So what all things you'll be doing additionally? Arrangement with the previous auditor, understanding the arrangement with the previous auditor, review the work of the previous auditor, right? Previous year financial statement, or maybe like balance sheet items, right? Inquiry with those predecessor auditor, additional inquiry with the management, right? Then testing of opening balance, because you like auditor opinion is on comparative financial statement. So when you are doing like audit report, you will be giving report on the comparative financial statement. As you are giving report on the comparative financial statement, it's being your responsibility to have an understanding or comfort on the opening balances, or else you can exclude, disclaim in your opinion that we have not conducted any audit procedure in the opening balances, and opening balances has been audited by the predecessor auditor. So there might be two scenarios we'll be learning in detail. One, you are assuming the responsibility. The second, you are not assuming the responsibility. When you are assuming the responsibility, you need to test the opening balances and disclosure of the previous year, right? And when
Why
you are
will
not,
we assume the responsibility? Because that audit has already been conducted, and we just need to pick up the opening balances and what kind of I'm not getting.
yes, yeah. So very good point, Ankush. Like when you see, like, let's say previous year, let's say A and B associate CPA firm have audited a company called, let's say Trimble. So they have conducted the audit of Trimble, and now Trimble is going big. They are now a unicorn, and they are going for a fundraising, right? And now to go for a fundraising, they require a good auditor stamp. That's like general phenomena in the market, and they go to the like PwC, EY, KPMG, Deloitte, and Grant Thornton to conduct the audit of their financial statement. Right. So in current year, let's say they have appointed, let's say, Grant Thornton as their auditor, right? So Grant Thornton would be giving the audit report, which is being attached with the comparative financial statement. That means user of the financial statement, user of those financial statement will assume that Grant Thornton has signing on both the numbers.
Yes.
Right? If, for example, we all are like CPAs, chartered accountant, we understand the fact. But general public, let's say if your dad or your mom, your brother or sister are not from finance background, not from accounting background, who do not understand much on these deep terminologies, right? They want to invest in a company, right? And they look at the financial statement audited by like EY, PwC, KPMG, Deloitte, or Grant Thornton. So they will assume like these numbers have been audited by these big companies, so I can rely on them.
Okay.
Right? To maintain the public trust in the financial statement, it's the responsibility of the auditor to look at the previous year numbers also. Make sense?
Yeah, but we will be having a look at those numbers, but we cannot. We also will be trusting, numbers
So,
based.
yeah, here also very good point. So, Ankush, Ayush, two things here. One is you look at previous year auditors' work paper, and if you are comfortable with that, no additional procedure are required. But if you are not comfortable with that, then there might be two scenarios.
Yes.
One, like management agree to give you additional document to verify, and you will verify and make yourself comfortable.
Okay.
Right?
Okay.
Second, management disagree with you.
Okay.
So if management disagree with you, then there are two options. One, you can say management requests the previous auditor to look at this matter again, and you will be do a joint meeting with the management and predecessor auditor and advise predecessor auditor or communicate predecessor auditor. These are like areas I found might have some problem. Request you to please look at it, and if you feel required to update your audit opinion on these areas.
Okay.
Right? Or otherwise, if management says you are not required to go to the predecessor auditor, you are not required to communicate to the predecessor auditor, then the last word in our hand is the modification in the audit report. In that case of scenario, we can disclaim the opening balances we have not conducted, so that users are relying on our report. So we are responsible to the public
Okay.
who
Yeah.
are relying on us. We are responsible to the bankers. We are responsible to the creditor because they are relying on us. Right?
Yes.
So we need to communicate in our audit report. We have not conducted any audit of the opening balances, and opening balances is being audited by the predecessor auditor, and we are relying on them.
Okay.
So
Okay.
yeah, so because like it's all about trust of the public, and
So
as
even
yes,
when we have verified it, like when they provided the additional information, or they have let us communicate with the auditors that, or we are relying on their work papers, what do we actually mention in our opinion
no,
that
then it's not required. If you
not
are comfortable, why do you modify it?
right? Then when we are not, when we are comfortable, we don't give any modification at all, and we have like we don't even write this sentence that
Not at all, not at all.
like yes.
Hmm.
Okay. Okay.
Right? If you see like General Motors audit report of 2018, so you can
Yes.
see. So I have drafted that.
Okay. Okay. Okay.
Cool. Okay. So non-audit engagement. Non-audit engagement. What all are non-audit engagement? Review, preparation, compilation, attestation,
Review, compilation.
right? And what standards we follow for the reviews?
SARS.
What standard we follow for attestation?
SSA.
Yeah, SSAs. Why I am emphasizing again, because you will be getting too many questions on this, and this question will definitely come in your exam. I can give you in writing for sure. You will see at least 1 or 2 questions on this, like attestation engagement comes in SSAE and review engagement comes under SARS. So that's the reason I'm trying to bring into your blood. Okay, so non-audit engagement. First thing, define the nature, timing, and extent. Like NT is the short form of nature, timing, and extent. Define the scope and nature, timing, and extent of the procedure required for that respective engagement. So in that, like, how do you develop an engagement plan? So when you're developing an engagement plan, first of all, like overall audit strategy at high level, then the detailed plan. So in detailed plan, you'll be having like defined nature, timing, and extent of the respective procedure, whether you're performing inquiry procedure, analytical procedure, examination procedure, inspection procedure, right? And who will be performing what for the respective financial statement line item. It is developed to achieve an overall audit objective. So when you are developing an overall audit plan, so or you can say detailed audit plan, the objective of developing the detailed audit plan is to achieve the overall objective of the engagement, right? That is the main reason of developing the detailed audit plan, to achieve the overall objective from that respective engagement. It must be developed to reduce the audit risk to an acceptable level. So how do you develop an audit plan to reduce the risk to an acceptable level? By developing additional audit procedure in the area where risk of material misstatement is high, or those area which is being identified as a significant risk area, or those area where you see the fraud risk might be there. In those area, you need to increase your audit procedure to make your audit risk to an acceptable level. So we'll be discussing in detail what is audit risk and how do you do the math for the audit risk. There's a calculation to it for how this audit risk is being derived. So we'll be doing those mathematical equation also. So now, procedure that auditor may consider in developing the audit plan for the respective engagement, right? First one is a review of like previous year audit work paper. I know like Sandeep has shared this, right? Do you know what is permanent file? Any idea? Permanent audit file. What is that?
We keep the documents, temporary file and permanent file.
What is permanent file and what all document you keep in permanent file?
In permanent file, we keep all the documentation on basis of which we have given the opinion.
But what I feel is maybe the permanent files has something that auditor is using continuously, like the
Yeah.
engagement letter and long-term contract or some agreement, all those must be the permanent papers.
Yeah.
Memorandum of association, article of incorporation certificate, revenue contracts, lease
Yes,
contracts.
right.
These are carry forward from year to year, so we
Yeah.
don't have to ask client again and again.
Yeah, absolutely true. Absolutely good, Ankush. Very good. So I think, Sandeep, hope you got the right answer. So in permanent file, we kept those documents which will be requiring year over year. And in your concurrent file or in your current year file or in your, you can say, audit file, you keep those documents which is being related to current year financial statement. So that is the difference between permanent file and concurrent file, or you can say current year file. So in permanent file, like Ankush beautifully explained, so you'll be keeping article of association, certificate of incorporation, or any other like certification for legal compliance or any such thing you have you are required for your company, right? And then your lease agreement, your long-term revenue contract, or you can say if you have labor unions, so union contracts, all those things which is carry over period over period. So those documents are being kept in the permanent file. Then you will be reviewing the previous year financial statement and the audit report, right? And then current year interim financial statement, if that's also done. So all these documents you will be reviewing to gain understanding of the client, right? Then you'll be discussing the scope and timing of audit with the management, non-audit services with the management or board of director or audit committee, as the case may be, right? Then you'll be performing inquiry with the management about like business development in current year. So is there any change in the business, like maybe new product line has been added, new service line has been added, or you can say new key management person has been appointed, or any old key management person has been left, right? Or any you can say major assets has been disposed of, any location has been newly opened, or any location has been closed, any service line has been closed, any product line has been closed. Like those kind of inquiry and discussion you'll be doing with the management, right? Then considering effect of applicable accounting standard and auditing pronouncement. Like in last couple of years, you've seen in 2018, we come up with a new accounting standard, which is ASC 606. Then in 2019, they come up with a new accounting standard 842. And now in 2020, they come up with a new accounting standard 326, which is being mandatory for implementation in 2021 and 22 respectively. Right? So you need to understand the impact and application of those new accounting standard, new auditing standard on your audit engagement, and where it is being relevant and required to discuss with the management, you will be discussing that with the management, right? Any industry update. For example, your client is in oil and gas industry, or might be they are using the raw material is coming from oil and gas industry. So how this crude oil price are being changing in international market, right? So those industries updates also being, you will be discussing with the management how those change in crude oil price is impacting your sales, is impacting your purchases, is impacting your inventory, right? Or you can say like if the company has offices or production houses in multiple location and dealing in different currency. Let's say, for example, you are a company in USA and you have a manufacturing hub in, let's say, in African countries, let's say like in Nigeria or maybe in Tanzania, right? And their currency is fluctuating very high. So how you are mitigating that risk, right? So those kind of discussion you will be doing with the management. Any updates in law or regulation, maybe if you see in 2020 when this COVID came, so new CARE Acts has came in United States of America, and there are a lot of amendment in many laws, regulation has been done back in 2020, right? How those change in law regulations are impacting the financial statement of the company, right? This COVID crisis, how the management is mitigating with this, or how management is preparing themselves to meet with this COVID crisis, right? What is their crisis management policy and how effectively they have implemented it, right? Extent of the involvement of specialists or internal auditor, like what all things internal auditor do, what all areas internal audit perform the audit, what is their audit mechanism, how much sample size they do, what is their strategies, understanding those. Then performing the risk assessment, and then nature, timing, and extent of the procedure at the relevant assertion level. So these all things you need to keep in mind when you are preparing your detailed audit plan, and then establishing the timelines for the audit and staffing requirement, right? So this is for the detailed audit plan, what all things you need to keep in mind.